Welcome to the Explainer. Imagine for a second that you are at the helm of a massive $15.2 billion ship. Now imagine trying to steer that absolute beast through a whole year of economic storms, wild currency swings, and totally unpredictable property markets all across Asia. Well, that's exactly the challenge Mapletree Pan Asia Commercial Trust faced in the financial year ending March 31, 2026. Today, we're going to break down their latest financial results to uncover the real anatomy of a truly resilient real estate portfolio.
To make sense of all this data, here's our game plan. First, we'll meet the portfolio. Then we'll break down the FY25/26 headline numbers. After that, we'll explore a tale of two markets, see exactly how management navigated the headwinds, examine their capital and debt, and finally, we'll reveal the bottom line. Okay, let's jump right in to Section 1, Meet the MPACT portfolio. This really is the $15 billion question of our explainer today. When you're managing that kind of money, you can't just pivot on a dime, right? You need some serious structural resilience built right into your foundation just to withstand these kinds of macroeconomic shocks. For those of you who might be a bit newer to the name, Mapletree Pan Asia Commercial Trust, or MPACT for short, is a massive real estate investment trust. They basically act as a direct proxy to key gateway markets across Asia, investing in some seriously high-quality income-producing office and retail real estate, and their footprint is huge. As of March 31st, 2026, we're talking 15 commercial properties spanning 5 major markets. They've got 4 properties right here in Singapore, 7 in Japan, 2 in China, and 1 each in Hong Kong and South Korea. Keep this geographic spread in the back of your mind, because as we're going to see shortly, this diversification, it's absolutely the core of their survival strategy. Moving on to Section 2, the FY25-26 headline numbers. Now, just to make sure we're all speaking the same language, you're going to hear me throw around these 2 acronyms a lot. NPI, or net property income, is essentially the profit a property generates from rent after you subtract the day-to-day operating and maintenance costs. Easy enough. DPU, or distribution per unit, is the micro-level view. It's the actual cash dividend that lands directly in an investor's pocket for every single unit they own. Okay, ready for the big punch? $867.03 million. That is MPACT's massive gross revenue for the financial year. It sounds like a staggering amount of money, right? But here's the catch. In the context of the previous year, that number actually represents a contraction. Let's look at the macro view of that contraction. You can see gross revenue dipped from $908.8 million down to that $867.3 million. So a drop of about 4.6%. Naturally, net property income followed suit, declining by 4.3% to land at $654.4 million. But notice this little detail here. Property operating expenses actually shrank, too, by 5.5%. So management was clearly in there actively tightening the belt. But why did the revenue dip in the first place? Well, that brings us nicely to Section 3, a tale of 2 markets. To really understand that revenue dip, we've got to look at this whole portfolio using an anchor and headwinds analogy. On one side, we have the Singapore properties acting as this massive, super stabilizing anchor. The data shows they actually enjoyed higher contributions thanks to positive rental reversion, which just means new leases were signed at higher rates than the old ones, along with step-up rents and less downtime. But on the flip side, the overseas properties face some truly severe headwinds. They got hit hard by lower occupancy, negative rental reversions, and, as we'll talk about in a second, a really punishing foreign exchange environment. So, the crucial takeaway here is just how much heavy lifting Singapore is doing for the whole group. Look at these actual NPI numbers. Vivo City, their largest mall in Singapore, brought in almost $190 million alone. Mapletree Business City, MBC, brought in $183 million. Meanwhile, their overseas crown jewel Festival Walk in Hong Kong brought in roughly $133.5 million. The Singapore anchor is definitely doing the lion's share of the work.
Let's dive into Section 4, Navigating the Headwinds.
Now, management didn't just sit back and watch the storm roll in. They executed a highly strategic series of divestments to shed weight and raise some much-needed capital. First up, they completed the sale of Mapletree Anson in Singapore back in July 2024. Then in August 2025, they offloaded 2 buildings in Japan, the TSI and ASY buildings. And finally, in February 2026, they wrapped up the divestment of the office component of Festival Walk in Hong Kong. They sequentially shed these assets to proactively lower their exposure to those challenging sectors.
And shedding that overseas weight was absolutely vital because of a massive, basically uncontrollable factor: foreign exchange shock. The Singapore dollar was just incredibly strong during this period. What that means is the money MPACT made in Hong Kong dollars or Japanese yen or Chinese renminbi automatically looked way smaller the second it was translated back into Singapore dollars on their balance sheet. It is a classic brutal currency headwind.
All right, let's look at Section 5, Capital Management and Debt. So what do they actually do with the cash from selling off all those assets? Well, surprisingly, despite having lower overall revenue, their balance sheet actually got safer. They took the proceeds from those divestments and aggressively paid down their debt. As a result, their aggregate leverage ratio dropped from 37.7% down to a very healthy 36.5%. And even better, their interest coverage ratio, which is the metric showing how easily they can pay their interest expenses, improved from 2.8 times to 3.2 times.
Now, they're still carrying $5.67 billion in total gross borrowings for sure. But because of those net repayments, their financial flexibility right now is honestly excellent. In fact, they built up a massive liquidity buffer, $772.7 million in undrawn committed borrowing facilities. If the market takes another sudden, nasty turn, they have plenty of room to maneuver. Which brings us to our final stop, Section 6, the bottom line. So what does this all mean for the individual investor holding the units? Well, the final distribution per unit for the financial year FY25/26 is 7.97 cents. Think about that for a second. Despite a 4.6% drop in gross revenue and all this currency shocks, the DPU only experienced a remarkably tiny 0.6% drop from the prior year's 8.02 cents. And that highlights our absolute core takeaway for today. This is exactly why diversification matters in a portfolio. The Singapore properties acted as a steadfast anchor, just consistently generating strong income. And while that anchor held, management utilized smart divestments and debt reduction to actively absorb all those nasty shocks from overseas property softness and currency depreciation. So it leaves us with a pretty fascinating question. As Asian markets continue to shift, fluctuate, and evolve, is a meticulously diversified model like MPACT the ultimate shock absorber for your real estate investments? It's certainly proved its worth this financial year by keeping the ship incredibly steady in some seriously rough waters. Thanks for hanging out with me on The Explainer today, and I really hope this deep dive helps you view these kinds of financial statements in a whole new light.